Welcome back to the channel. I'm Javi, and today we are diving into Lemonade Insurance and why I think it has a lot of potential for the future. So stick around and let's dive right in. To begin, Lemonade is a tech-driven insurance company that's been shaking up the industry with its AI-powered platform. Their current stock price is hovering around 18.5 right now, and they have a market capitalization of 1.32 billion as of 8/26/2024. Lemonade Insurance does offer a variety of options for insurance, such as homeowners insurance, renters insurance, car, pet, and life insurance. Their renters insurance is available in 38 states and it's growing fast among millennials. The total addressable market for renters insurance is around 4 billion, and Lemonade currently holds about 10% market share in some states. The home insurance covers 23 states with a steady growth. The total addressable market for homeowners is about 100 billion, and Lemonade has a market share of 1.6% in the USA. And their car insurance business just launched and is available in 7 states. The total addressable market for car insurance is a whopping 300 billion, and Lemonade is still attracting market share in this segment. For pet insurance, it's available in 38 states, which is gaining popularity, and the total addressable market for pets insurance is about 2 billion, and Lemonade is rapidly expanding in this business. Life insurance is available in 50 states, a newer addition, but it is expanding rapidly. The total addressable market for life insurance is estimated to be 800 billion, and Lemonade is making huge strides in this area with its quick approval process. Do own the shares. I am averaging 12.47 for my shares right now. I do have more shares in my SoFi Invest account as well. My total portfolio diversity is 2.9%, which is good to keep a diversified portfolio in case Lemonade does not make it. With its market cap being at 1.32 billion, I think Lemonade is severely undervalued as compared to its competition. Granted, it is not profitable, so looking at its negative PE ratio here of -6, comparing it to Progressive, one of its competitors, Progressive is at 142 billion with a PE ratio of 20, and they are paying a dividend. So what I usually recommend for investors is to diversify their portfolio into different companies, essentially like creating your own ETF. As of right now, Lemonade Insurance is the only one that I'm holding within this sector. I might diversify a little further by adding Progressive later on because Progressive does have a PE ratio of 20 and it is more established and it does pay a dividend. The reason you would buy Lemonade is because it has growth potential. They are estimating that next year they will reach profitability and they will have a positive PE ratio. The dividend, I'm not really investing for the dividend. I'm kind of holding it for 5 years or longer in hopes of it reaching 142 billion, which is exponential growth. But they have a lot to prove. Other competitors worth noting are Liberty Mutual, Allstate, and Geico. Geico is owned by Berkshire Hathaway, which I believe is a good stock to buy as well. It's good to have a neutral stance on the stock market. Don't develop any emotional feelings about specific stocks. Always diversify, and your portfolio just gradually grows slowly and steady. Lemonade does set itself apart with its innovative use of AI and its unique giveaway program. Their AI is known as AI Gym, and it handles everything from policy signups to claims processing. AI Gym can handle claims in as little as 2 seconds by analyzing video submissions and running anti fraud algorithms. Lemonade's Give Back program donates to charities chosen by their customers, making a positive social impact. Here on Lemonade's page, it has the different states that their insurance policies are available. So, for example, renter's insurance is available in these states. The homeowners insurance listed here, condo insurance available Arizona, California, Colorado, and car insurance is available in Arizona, Illinois, Ohio, Oregon, Tennessee, Texas, and Washington. Pet insurance is there. And they are also in Europe, including France, Germany, the Netherlands, and the United Kingdom. And they are coming soon to Austria, Belgium, Bulgaria, Croatia, the Czech Republic, Denmark, Estonia, Finland, Greece, Hungary. I am hungry. But yeah, and you can see the rest listed right there. Moving on to their earnings report, they published it on July 30th, 2024, and we can review it briefly and point out key things that they're expecting. They have an in-force premium of 139 million, which is an increase of 22% year over year. They have an average of 387 dollars premium per customer, which is 8% year over year growth, and their total customers grew to 2.1 million, which is a 14% increase. Their gross loss ratio is 79%, which is a drop from 94% to 79%, which is very positive. It's a 15% year over year change. They have an adjusted EBITDA of negative 43 million and a net loss of negative 57 million and a gross earned premium of 200 million with a net loss of percentage of 29%. But as you can tell, it has improved from 64% from quarter 2 2022 to quarter 2 24. Lemonade is net cash flow positive for quarter 2 24, and they expect to remain net cash flow positive moving forward, with the exception of quarter 4 24 due to their seasonal cash flow patterns. From their balance of 931 million, they expect their cash and investment balance to dip by approximately 1 to 2% before consistently climbing. Moving on to their loss ratio, while quarter 2 24 saw a surge in natural catastrophe events, or CAT, across the industry, driving elevated losses for many carriers. Their 79% gross loss ratio results were notably stable. Indeed, reducing their CAT related volatility has been a major focus for them, and they've implemented the following strategies: growing products with lower CAT exposure, notably the pet and renters insurance, growing considerations when it comes to homeowners growth, including diversification via Europe, continuing to sell Lemonade homeowners policies only where their AI powered long term value models predict attractive unit economics, and simultaneously placing home premium with other carriers in select geographies to ensure that they are able to deliver a sustainable long-term solution for all customers. They also begun non-renewing certain cat-exposed homeowner policies that would not underwrite today, given what their AI-powered long-term value model has learned. This effort will ramp up considerably in the second half of 24, impacting their in-force premium by roughly 20 to 25 million, which is built into their guidance. In the past couple of years, they've had impressive operating leverage with a dramatic growth in the book of business alongside relative stability in operating expenses. Some notable statistics: over the past 2 years, they've had a compound annual growth rate of in-force premium at 35%, is more than 3 times the CAGR of operating expense at 11%. Excluding their growth spend, of which 80% is now funded by their synthetic agents partners, all other operating expenses were roughly flat. In the past year, they grew the book by 22%, while their employee headcount actually shrank by 9%, contributing to a 34% improvement in in-force premium per headcount. Since quarter 4 21, in-force premium and headcount was steadily increased, improving by more than 2 times over that horizon. Wow. Looking at the line chart, you can tell from quarter 3 22 to quarter 2 24, their in-force premium increased from 609 million to 839 million, and their operating expenses dropped from 87 to 81, and their in-force premium per head count from 340 to 693. Essentially, these feats are significant because they show the ability to leverage technology to automate systems and processes, unleashing their operating efficiencies. The good news is that they do predict that their in-force premium will continue increasing and their operating expenses to continue decreasing due to these systemic changes that they've implemented. They also provided this chart to compare traditional operating models and their digital operating model. So here in the beginning, they kind of take a dip in their growth, but it becomes exponential once you get enough clients and you can continue advertising versus traditional companies such as Progressive, Geico, and those other places. They have this exponential growth at first. It kind of leans back down at the end compared to the digital operating model where you don't really have brick and mortar buildings that you have expenses for. All right, if we continue scrolling down, it's pretty much a summary of everything else that we've seen already. 22% in in-force premium, customers increased by 14%, premium per customer increased 8% from the second quarter of 23. Their gross earned premium or JEP increased 22% as compared to the second quarter of 23. Their revenue increased by 17% as compared to the second quarter of 23. Their gross profit increased by 18.7 million or 155% as compared to the second quarter of 23. Their adjusted gross profit increased by 16.8 million or 101% as compared to the second quarter of 23 again. Their operating expense increased by 13% as compared to the second quarter of 23. This increase was due to a higher growth spend for customer acquisition, but it was offset by lower employee related cost. Growth spend included in sales and marketing expense was 25.8 million in the quarter as compared to 12.5 million in second quarter 23. Overall, the net loss in the second quarter was negative 57 million or 0.81 per share as compared to 67.2 million or 0.97 per share in the second quarter of 23. So overall, an improvement. They also attached some key operating and financial metrics. It's essentially the same thing that we just read above. Their annual dollar retention increased from 87% to 88%. Their, let me see, total revenue increased from 104 to 122. Gross profit 12.1 to 30.8% within the last 3 months ended June 30. Their net loss 67, negative 67 to negative 57. Their gross profit margin went from 12% to 25%, which is really good. It's starting to increase. And again, gross loss ratio dropped from 94% to 79%, and their net loss ratio dropped from 99% to 79%. Overall, good numbers for the quarter. Okay, moving on to the bread and butter, their guidance for the fiscal year of 24 for all metrics. They do expect familiar seasonal patterns to repeat for quarter 3 and growth spend in quarter 3 expected to be 3 times prior year amount and lower loss ratios in quarter 4 leading to the following expectations for third quarter 24. So they do expect an in-force premium at September 30, 2024 of 875 million to 879 million, which is 22% increase growth year over year. Gross earned premium of 208 to 210, which is 21% growth year over year. Revenue of 124 to 126 million, which is 10% growth year over year. Their adjusted EBITDA loss of 58 to 56 million. Stock-based compensation expense of approximately 17 million. And capital expenditures or CapEx of approximately 3 million. Weighted total common shares outstanding of approximately 71 million shares. Their full year guidance for 2024, they expect an in-force premium at December 31, 2024 at 940 to 944 million, which is 26% growth year over year. Gross earned premium of 818 to 822 million, which is 22% growth year over year. a revenue of 511 and 515 million, which is 20% growth year over year, and an adjusted EBITDA loss of negative 155 to negative 151 million. Stock-based compensation expenses of approximately 64 million and capex of approximately 10 million. Weighted total common shares outstanding at approximately 71 million shares. They also included some charts at the bottom of this presentation. Pretty much the same thing, just kind of showing their customer gain from 1,500 to 2,100 from quarter 2 22 to quarter 2 24. Their premium per customer has increased gradually from 290 to 2,387. That pretty much equals their in-force premium from 427 million to 838.8 million. And this is their gross earned premium from 106.8 million to 199.9 million, which is a 22% increase from the prior quarter or year over year growth, sorry. The revenue grew from 50 million to 122 million. Here's a graphical representation of their loss ratio from 94% on quarter 2 23 to 79% for this current quarter. Gross profit increased by 155 to 30 million from 12 million. Gross profit margin, it was at 23 in quarter 2 22, dropped to 12% for quarter 2 23, and it increased again for quarter 2 24 to 25%. There's a bar chart of the operating expenses that includes the general and administrative, technology development, sales and marketing, and other insurance expenses. And their net loss, pretty much it has improved from 67 to 57 million in the negatives, and adjusted EBITDA also has improved from 52 to 43, which is an improvement of 18%. Total cash investments, and here's a graphical representation of their net cash flow from quarter 2 23 to quarter 2 24. As you can tell, it was negative 51. It went to $3, then it was at 0, dropped back to negative 18, and they are projecting that it will continue going higher from $4. And here's their guidance for quarter 3 24, including the full year 24, for in-force premium 875 to 879, their gross earned premium 208 to 210, revenue of 124 to 126, and adjusted EBITDA still negative at negative 58 to negative 56 on the high end. Full year guidance, in-force premium of 940 to 944, their gross earned premium 218 to 822, revenue of 511 to 515, and adjusted EBITDA of 155 to the high end of 151 negative. That pretty much concludes their earnings report and their forecast. Please keep track of the trends for their earnings report. They do predict that for the year 24, they will reach profitability. I predict that it will most likely be by the end of 2025 because so many things can happen on Earth, such as earthquakes, hurricanes, snowstorms, heat waves, so many things that can happen to properties, to renters, and to people's cars. So keep an eye on those trends. If you can, listen to the next earnings report. They do have an event coming up on November 19th as well, where they will discuss more information about the stock. Otherwise, that pretty much concludes this video. If you found this video helpful, please hit that like button and follow for more stock insights.